Hi, everyone. Welcome to the January CAM Investor Solutions webcast. We are going to give it just a few more minutes until everyone has joined. So just give us a few minutes. As you're waiting and coming into the webcast, if you want to enter in the chat or Q&A where you are dialing in from today and maybe what you're having for lunch, if this is your lunchtime. I'm in Austin. Mark is in Austin. Sarah is in Tampa. I am having leftover orzo sausage thingy for lunch. It's amazing. Sarah, what are you having for lunch? Maybe you already had lunch. It's 1 o'clock in Tampa.
Yeah, I kind of had like a late breakfast, so that's how I'm operating today.
Mark, do you have breakfast tacos?
Nope, undecided so far, so nothing yet.
Awesome. We're gonna give it another minute, and then we'll get started. All right, well, to try to stay on time and get you guys out of here so you can get to those lunches wherever you are, I'm going to get started. Thank you for attending our webcast. Again, we are having these every single month. It's a new endeavor for us. We are starting them based on feedback from clients that you want to hear from us on key topics that are top of mind for you. I am Melissa Calhoun, a wealth advisor and director of client communications here at CAM. I'm joined by Mark Jimenez, our founder, senior wealth advisor, and chief investment officer. And our senior wealth advisor, Sarah Contino, is out of Tampa. So thank you all for joining. A few housekeeping items. This is being recorded and we will send you a copy of it afterwards. So if you can't stay till the very end, that's okay. But we would encourage you to stay till the end because we have some exciting CAM updates to go over specific about CAM at the very end. Also, if you have any questions for us, please submit those in the Q&A or the chat. I'll be monitoring those and we'll try to get to as many as possible today. And if we can't, we'll try to get with you afterwards, or always feel free to send us a meeting invite and we'll discuss those with you one-on-one. Here's some disclosures that we have to share with you for compliance. You'll be able to read these in detail during the recording. To cover our agenda, I'll go over market updates or market performance for 2024 and some key questions that we're hearing from clients. Sarah will cover how we think about investing at CAM, why we think about it that way, and how we implement that in practical application to your portfolios. And Mark will share our insights for 2025 and how we are adjusting portfolios accordingly. And last but not least, we'll get to those questions and those CAM updates. So we're hearing a lot of questions from clients. These are some common ones. We just wanted to kind of say, we're going to try to cover as many of these as possible throughout the presentation, but hearing a lot of questions and news about inflation, tariffs, will those get implemented? We had two really strong markets these last 2 years. Can we have a third one this year? Is it possible? Should we stay invested with this new administration? And a lot of unknowns about what's going to happen. Real estate, will real estate finally have a good year after many years of having lower performance with high interest rates? And then insurance, everyone's asking what's happening with insurance rates and when will those come down? Will they come down? Will I be able to have insurance coverage? If you have any questions like this and we can't cover it today, please again, reach out to us. So I'm sure you all tuned in to get our 2025 predictions. Unfortunately, we don't have a crystal ball, so I'm sorry to disappoint you. We don't have predictions today for you. But this kind of is a nice chart to show you how the S&P 500 performed over the last several decades. And you'll see 24 and 23 were amazing record years, well above the historical average, which are these two lighter green bars. And the average is typically between 10 and 12%. So what are we hearing for predictions for this year? Well, we're hearing, again, in that range of 10 to 12 to 15% for 2025. Are we listening to those predictions? Not necessarily. You'll see this chart shows predictions by some very brilliant analysts that do a lot of market research. And you'll see in 2024, they had a pretty conservative prediction, thinking the market would return 10 to 12, 15%, kind of what they're saying this year. If they were right, it would have been on par with historical averages. But the black diamond at the top shows how the market actually performed. And you'll see it was much higher. So if you listen to those analysts last year, pulled back on your stock investments, maybe put some more in cash, you could have missed out on a really good, strong year. There's a lot of unforeseen events from economic shifts, geopolitical shifts, disruptions that can quickly render these really good, well thought predictions irrelevant. And as we said, we don't follow those predictions. We focus on 3 tenets that we really think are important for clients to remember, which is we believe that markets work, we focus on what we can control, and we believe that diversification is your friend. So Sarah will go into all of those a little bit in a little bit. So are we following predictions for this year? We're not. We don't know. We don't have that crystal ball. So how did 2024 perform? This is a chart showing some of the big headlines in 2024. You can see this on our website and one of our blogs that we posted earlier in January. And it's overlaid with the S&P 500 performance for the year. The green dots are some all-time highs. So there were 57 all-time highs in 2024. It may not have felt like that with some of these drawdowns. In July, there was a big one. Earlier in the year, April timeframe, there was a big one. The red dots are actually all-time lows. So even though you saw big drawdowns, those were not all-time lows. There's only a couple at the beginning of the year. So going into 2024, there were a lot of concerns and unknowns, a lot of questions about recession versus inflation, who would become the president, will the Fed start cutting rates because they hadn't yet, will wars end or new ones start? But you can see even through all those fears and a lot of anxiety, the market still had a great year, performing over 20%. Going into a little more specifics, the mega cap technology stocks really led the way for this amazing performance. If you've heard of the Magnificent Seven, they had a lot to do with how the S&P return performed in 2024. That was driven a lot around excitement for AI. But there were strong performance across the board and across geographies. Small cap stocks and emerging markets rose 11.5% and 7.5% respectively. In contrast, large cap stocks struggled a little bit with only a 3.8% return. That was constrained by US outperformance and a strong dollar that we continued to see here in the US. Bond markets saw a lot of volatility in 2024, with yields rising more than expected, even as the Fed cut the short-term rates. The 10-year Treasury yield climbed from 3.95% to a little over 4.5%. And the 2-year Treasury remained nearly flat for the year, starting at 4.33 and ending at 4.25. So although the yield curve was inverted for much of the year, signaling economic concerns, it later normalized as long-term yields rose. And last but not least, it's not on this slide, but alternatives are something we offer for clients interested as a very good diversifier during turbulent times like we saw last year for stocks and bonds. The reinsurance market had a great year, seeing an over 17% return. And for those looking for some diversification in your fixed income side, direct lending, which we use Cliffwater for, saw an over 10% return for an alternative on the fixed income side. So a really good diversifier for clients and concerned about tumultuous markets. So that's a wrap on our market overview. And I'm going to turn it over to Sarah Contino, who's going to talk about how we think about investing here at CAM.
Thanks, Alyssa. So whenever I look at investing, I first always defer to my favorite quilt chart. This is obviously running from 2005 to 2024, but I have copies of these going back to late 90s, and the story is almost always the same. Each of these colored boxes is, of course, going to represent different asset classes. If we follow along with some of them, we really can't make a prediction about what the returns are going to be from one category to the next. So if we pick on emerging markets, which is in orange, in 2017, it was a top performer at 37%, but then we can follow it through to 2018 and see that it was down 14%. Very similar with large cap equity in 2021, up 28%. And then a negative performance, down 18% in 2022. All this to say, this is why we can't really guess or predict what is going to happen with a stock or what's going to happen with an asset class or even the overall market. So what we really lean heavily on is evidence-based investing, which essentially just means we're using decades of academic research to be able to help provide information as to how we should be building portfolios. And with that, customized strategic allocations, of course, are going to be incredibly helpful. So customized because, yes, we want a framework. We want to be able to use the disciplined approach and all of the academic research, but we also want this to be customized to our clients' needs and have it help them accomplish their goals. So traditionally, investment portfolios, many probably think of them as stocks and bonds, but we've seen so much high correlation, meaning they kind of act the same throughout different markets, that this is why we're introducing more things, as Alyssa was talking about, credit markets, private equity, real estate. We really feel like we have to expand that diversification in portfolios. And then, of course, monitoring and rebalancing is just as important as being able to put that into place in the first place. So rebalancing, I always say we don't want the market rebalancing our portfolio for us. So active rebalancing and making sure that we can make those small adjustments as needed helps with success. And even though we have all of the structure established, I still think adaptive strategy does come into play here, because when we have a lot of things that are occurring in the market, we've talked about inflation as a factor or potential tariffs, we have to be able to think about how those have some impact on portfolios and make minor adjustments if need be. So if we move on and then look at, why do we do this? Why do we invest the way we do? I always kind of lean back more to the psychology. Another one of my favorite charts kind of highlights what happens to investors' emotions when we're going through different market cycles. So, of course, as the market is going up, there's a lot of optimism. We could even get to the point of elation. Typically, this is when we find folks feeling like, hey, I can't lose. I'm throwing money into the market. We're going to absolutely have great returns. But as we could see from the chart previously with the quilt chart, those cycles will ebb and flow, right? So we will see a time where that market or that asset class will start to drop again. And this is where we often find clients get nervous. We even get to a point of fear. At that point, sometimes people want to hit the button, and eject on their portfolio. We don't want to have a scenario where we are buying at the top from elation and then selling at fear, not buying high and selling low. We definitely want to avoid that. So trying to keep psychology in mind, and this is why we go back to a lot of the evidence-based investing, the allocations, and a more structured process. So again, a client-centric approach just means that we want to have you at the center of the solution here as you're looking at what your goals are and how we can help you accomplish that. Long-term stability just means that we want to have a smoother ride. We don't want to have the speculation and the gyrations in your portfolio, and we want to minimize risk as much as possible. And then that disciplined process, again, going back and rebalancing, being structured about it. We don't want emotions to be the control point here for successful management. Trust and integrity, hopefully you all are here because you trust us. And I think that's a big part of making sure that we can effectively communicate together and make sure our clients are ending up on the right path. So this was also just a really interesting slide that we wanted to show. If we haven't talked about it before, I'm sure you've heard from some of us discussing the efficient frontier. And all that essentially means, and what this chart is trying to represent, is expected risk. So from left to right, we've got how much risk a particular asset class can take. And then from bottom to top, we're looking at expected 10-year percent return. So what we want to do, and sort of the name of the game here, is get the best return with the least amount of risk. Some of these categories are going to take on more risk and therefore more return. Obviously, at the very conservative end, we have cash, which historically has returned somewhere around 3.5%. And going out far onto the standard deviation or the high risk category, we've got emerging markets, which, while it's taking a lot of risk, sometimes has also offered us some better returns as well. So again, this is where we want to kind of mix into our allocations a little bit of each of these, and also being very mindful of how we're managing risk, so that ultimately, again, right, we're just wanting our clients to meet their needs and goals and have a successful outcome. So I'll actually, since we talked a little bit about the adaptive strategy, Mark, I know, is going to talk next about how we can kind of think about some of those. So while we've had this process in place, we also want to be able to be mindful about the things coming up in 2025. So he will talk about some of the aspects of the changes that we've made in the allocations in our portfolios.
Thanks, Sarah. Thanks, Alyssa, for doing a great job of bringing us up to speed, and thanks for keeping me in line sometimes with not getting too far off track here on discussions like this. But I'll just quickly want to just recap a little bit of what you've seen already, and then I'll dive into not just some data points I think you'll find of interest, but also kind of tied into why we made some of the changes that will hopefully make sense. Real quickly, as Sarah mentioned, everything we do is evidence-based, as a process, right? So it's not us behind the scenes like the Wizard of Oz, pushing buttons and throwing darts. As you probably have seen a lot in the media, this has been all the rage about the Mag 7. 2024 is a good year. We've all, I think, agree on that. We know that from the big companies to the tech companies to the S&P, even the small Russell 2000 companies were positive 10%. In most years, that's a really good return, even though it looks very tiny compared to everything else. And then there's some data points you see in the top chart that just show what happened around the election and since, which we can get into later. But I want to point this out because it was another good year. And down below, you see the S&P 500. It had back-to-back gains of over 20%. And that's something that we actually hadn't seen since the 90s, in case anybody was curious. And that's not a forecast on what's going to happen next, as far as up or down in markets. But one thing that, for the context or the scope of this call, it's too much to show. But when you see big gains like that in a certain indice, the one thing that is pretty constant is volatility has picked up quite a bit. And this isn't a forecast, but if it follows suit with history, I would expect some volatility in markets this year. Again, not bad, but volatility because of policy changes, uncertainty on the timing of policy changes, interest rates. There's a Fed meeting this week. There's a lot of things that are transpiring that no one knows for sure how it's going to play out. But ultimately, with that uncertainty, volatility could appear or could rise. And there's some evidence around that. All that brings for all of our clients in our process is opportunity, is how we view it. Opportunity to rebalance, tax loss harvest, do some things that can take advantage of opportunities for investors. So we'll come back to that probably later in Q&A. Next slide. As I mentioned before, we all know the markets did well. Up on the top chart, I want to highlight a few things that maybe some aren't aware of. And this is, again, why we rebalance, why we own a lot of things for clients. If you look at the S&P 500 index, it had a very strong performance, NASDAQ, the Russell. And you can see that the index had a solid return from its lows, but also the index itself in 2024, there were some downtimes. The S&P at one point had lost 8%, the NASDAQ at one point had lost 13%, and the small companies had lost about 10. Probably more interesting was that the average member on average, in these indices at certain times of the year had actually lost much more than that, right? If you exclude a few of those big name companies that we've all talked about, you've heard about in the media and the press, the average member in some cases lost almost 50% if you look at the NASDAQ, almost 40% if you look at small companies, right? And even the S&P, which has been, all the rage this past couple of years, we just saw almost 20%. So there is a reason to own a lot of stocks. And we do own a lot of stocks for our clients in the thousands, not hundreds, but in the thousands to help mitigate some of these unknowns. Now, down below is the last point I'll make on some of the Mag 7 is that, well, that was talked about. There's a lot of companies on this top 10 list that were the best performers in the S&P that I pretty much guarantee, including myself, didn't know who they were before putting this chart together. I didn't know who Vistra was. I didn't know who Targa. I thought it's a Target. It's Targa Resources. And some other ones here that maybe none of us would have thought. United Airlines, while people were traveling more, who would have thought that an airline was one of the best performers in the S&P? Not something we would expect that, again, why we own thousands of companies and why trying to guess in advance is really hard. So just wanted to highlight that to kind of validate some rationale. Here, as we got into 2025 or at the end of 2024 even, you hear us say a lot, and when you first start to work with us, perhaps if you're a client or if we're talking about how we might allocate for our investors, is we try to capture what the market is giving us. We try to do that in the most, low cost, well-diversified, tax-efficient manner. And what happened in markets from 2023 to 2024 at the end was pretty significant. And it just drove home the point of why we made some changes. At the end of 2023, for example, the US markets, the US public equity markets were about 60% of the eligible or the total global market cap. And from the end of 2024, what that moved to was 67%, almost 70%. So there was a big change. Now, some of you may ask, why is that relevant? So if you think about all of us, we typically have worked to earn dollars. We spend in dollars. We kind of are familiar with a lot of, how U.S. markets operate. But typically, to really achieve global diversification, we want to capture what the market's giving us. So we have to own a lot of things that look like the market. So we keep that same process in our philosophy. And what we did was in 2024 to 2025, we did add more in our changes, gradually for some clients to the US markets. Now, did we just put it all in the S&P 500? No, we didn't do that. There's a reason for that. Down below, which I'll get to in a second here, it shows some of the revenue exposure, versus the country. And in the UK down below, over 70% of its revenue to its markets comes from overseas companies, other countries, right? In Japan, it's over 50%. In the US, it's over 40%. That's significant. That's significant for many reasons. If you go to the next slide. There you go. So it's significant because one, if you are trying to manage risk, right, you want to know what you own. You want to know what you own and what it's tied to, because in times of distress, times of markets when things go badly in economies, recessions, typically a lot of risk assets all move in the same direction. So it's good to know what you own. Now, in terms of our allocations for clients, if we own more of the S&P or someone says, I don't want to own international stocks because they were terrible. Okay, that's great, but if you own the S&P, you might actually be owning more international than you think, right? And in the US, over 40% itself comes from overseas companies, of those S&P companies. So it's something to think about if you're saying, hey, I'm going to be safe in the S&P. Also, when we're allocating to, hold on, go back one second. When we're allocating to US stocks, we want to make sure that we are owning things that aren't tight. So often when we made changes last year and this year, we maybe bought still companies that were large cap companies, highly profitable companies, but also smaller, cheaper companies. Some companies that were trading at 30 to 40% discounts of their big company counterparts. And even overseas, we own some things that maybe weren't tied to those large companies. So again, just some data points and knowing what you own. Next slide. Now I'll touch on this briefly because we've talked a lot about it and there's probably going to be some Q&A about it, but interest rates continue to drive a lot in markets, not just in the US, but globally. This week, we have a Federal Reserve meeting where they'll probably, comment on rates a lot and talk about their predictions or what they're going to do for the year ahead. We try not to get involved in that. We don't control that. But we are aware that, look, rates, some may say, are still too high, need to come lower. We argue that they're just in line with historical 4.5 to 5.5 averages over the long term. So maybe if they are back to normal, it's something that, one, it might hurt some interest rate sensitive assets, right? But also it presents opportunities, and you've heard me say that a lot. It presents opportunities to take advantage of these rates while they're high. You know, you don't have to own some of those stocks that are super sensitive to higher rates. There's a lot of other companies that benefit in the fixed income markets, owning things beyond just traditional bonds, which continue to struggle, than non-traditional fixed income or private lending and private credit and things that just get higher returns for clients. So there's a lot that can happen there. And we expect, our view is that, look, the Fed's telling us they're going to drop rates. At some point they will. We just don't know when. But we're going to put our clients in a position to take advantage of rates while they're high. And that's it. Next slide. You saw this slide from Sarah, and she did a good job highlighting this. Beyond this kind of magical, efficient frontier and how to allocate to the right parts of the markets, this is taking a really consensus view of some of our industry partners that we work with in terms of how they allocate to their portfolios, right across stocks, cash, bonds, private assets. And for us, we like a lot of these areas for clients. Some of them more so than others for clients, depending on their needs and circumstances. The things that I want to highlight here as we kind of think about what changes we made this year, I talked about, hey, we've added more to the US selectively into maybe smaller companies that were cheaper, more highly profitable companies. We decreased international, so we weren't as correlated or tied together globally. But in other asset classes, we added or maintained our exposure to areas such as private debt. We maintain US stocks because, again, where we earn and live and spend is important, but we like cheap things, right? We like maybe some of these areas of foreign stocks that were trading cheaper. Cash we still like. I'll pick on cash because while it's been a darling at 5%, now 4% and trending lower, eventually the Fed does what it's supposed to do. It's going to keep lowering rates. And something for our investors we'll have to be mindful of is that how are they going to reallocate cash? Fixed income, 4.8. I would be surprised if that number is achieved over that time frame. The point is there's a lot of other areas that we invest in for clients where it's appropriate, and we want to make sure that our clients are aware that some of these might make sense for them at some point. So real quickly before we jump into Q&A and I hand it back over to Alyssa, I want to think about if y'all take a second and kind of forecast 10 years in the future. And we're looking back over the last 10 years, it's January 2035. What happened in markets? If we look back, and I'm just going to pretend I know the future. US stocks. US stocks, weren't negative over 10 years, but they returned a measly 6% average over that time horizon. Again, not bad. Was it 24% like we saw last year? No, but there's a reason why we were happy that we owned other things besides just US stocks. Bonds were still terrible. All right. Bonds were still terrible because they were still getting 2% and 3%, 4% in accounts for investors when maybe there's other types of fixed income investments beyond traditional bonds that one can own. So we were happy that for clients, we allocated to a lot of different types of both traditional and non-traditional fixed income. International stocks, they were the darling. They had their version of the roaring 20s, right? They had double-digit returns on average through the whole decade. We were glad we owned some. We didn't own all the portfolio, but we're glad we owned some for our clients, and they did well. Private equity, most of it was crap. Sorry for my language, but most of it was crap because a lot of it was sold for the benefit of the manager, for high fees, and not needed for clients. But there were some good investments in there that actually diversified and gave clients access to exposures that they can't get in public markets. Those are the ones we added to for diversification and managing risk. We were happy with that. But like a lot of private equity, you have to be careful, and we were, so we shied away from most of it. Crypto, over 90% of all coins, digital assets, lost money or went to zero, right? The only ones that made money were the meme coin and chicken wings and the coin for Taylor Swift. That was it, all right? Those are the only ones. But again, we only own 1% to 2% in this area for some clients. We don't own a lot of it. And that's important to say because we don't know what the space is going to look like in the future, but we know it's volatile, we know it's risky, and we know, like any asset class, you only want to own the right amount. So we did, but very selectively. Active management was still a fool's game, throwing darts, nobody should get involved with. Hence, we don't do it. We have an evidence-based approach, like Sarah said. That's our process. And liquid alternatives, they were the worst performer of the decade ending 2025. Everyone's sold except for us, and they serve their purpose in diversifying risk. So we're glad, like a lot of asset classes, we held on to. So again, I'll take that hat off for a second of forecasting, and I'll hand it back to Alyssa.
Thanks, Mark, for giving us the insight in what 2025 will look back, or the next 10 years will be. So as we look back, let's move to some questions because we are getting close to time. We had a question that actually didn't really come up in our presentation about taxes. There is concern this year they're supposed to end and what will happen with that. Sarah, do you want to take this question about will we face a flat tax rate, maybe more of a sales tax rate? Any concerns about the Roth accounts, and will people lose their Roth benefits after they've paid those taxes already? Sarah, you're on mute. Also a phrase from the COVID era. Hey, you're on mute.
Thanks, Alyssa. So yeah, really great question. I think first, Roths are always something that a lot of folks, I know I talk to a lot of my clients about. If we are assuming that our tax rates will stay the same or go up, they're likely going to be beneficial for a lot of people. So then the concern becomes I'm paying tax now, either because it's being funded out of my pocket or I'm converting. And what if I lose this benefit in the future? So that might be the concern if, of course, we're moving to flat tax. And I know that while it's been a discussion point, I still don't see it as big of a risk. I think there's too many people that will lose out. And I think politically, there's a lot of hurdles that we would have to overcome in order to see that actually come to fruition. So even the things that we see are likely maybe teed up and moving forward, that to me seems like right now it's kind of on the low end of the priority chain. So I would say maybe consider that to be not as big of a concern. I still would favor Roth and Roth conversions if it makes sense for your situation.
Thanks, Sarah. I love Roths too. Try to put as much money in those and get the compounding effect.
Exactly.
Mark, a question for you around if we're trying to be conservative to mitigate downside risk, do we think that there will be symmetric or asymmetric risk rewards if we're comparing to, say, the S&P 500? How can we think about if we're concerned, if I'm concerned about risk this year?
Yeah, there's probably two parts to that at least. So the kind of question for the audience is, is there a reward, or is there a way to invest and get rewarded for taking the right kind of risk without giving up too much downside exposure, but maybe still capturing some of the upside? So I think one, if you think about just investing in stocks, I'll pick on the S&P again. If you just own the S&P only, right, there's a certain level of risk and return. But I'd argue that you could have just as much upside by owning more than just the S&P in terms of stocks and cushion your downside. So there are some ways to cushion downside by owning a lot of different risk assets or stocks to begin with. And the more you typically add, you can actually still participate in the upside without having all that downside. So the answer is yes, but you have to do it methodically and in a smart way.
Right, there's no free lunch.
Exactly.
We've got a question about Social Security regarding solvency in the next decade. Do we think that what's our view on that? Do we think the government will continue to do a series of last-minute bailouts? So I don't know which one of you wants to take your thoughts on Social Security and it being at risk.
I mean, I'll throw in my 2 cents on what I typically cover with a lot of my clients is that, the Social Security bucket running out kind of means that we're going from a surplus to living paycheck to paycheck. I do think for those of us who still have a number of years before we can start tapping into Social Security, might start to see some impact in benefits, whether that's just a delay. I don't know from a reduction standpoint. I think when we're doing planning, I usually, if somebody's concerned about it, we'll say, let's plan for like 75% of what your statement says you might get. I do think it's a problem that can be solved very easily, but it again goes back to the political landscape. So I think it has to get to a point where people decide, people as in those beyond our yard here and who have the control over that to make some decisions about how they can resolve it.
Thanks. Yeah, I'm a long ways from Social Security, so I'm just saving a lot. Who knows? Um, Everyone's talking about it on every radio, every headline about inflation. Do we all have any predictions about inflation for this year?
Like I covered a little bit on interest rates there. So interest rates are being, or the policy is being driven, by some of the inflation data, right? Whether you measure it by CPI, PPI, or some other metric. Um, the data is suggesting things have come down from what they were just a couple of years ago, so that's good. Hence why rates are maybe down a little bit, but the economy remains strong. So if the data continues to cool, I would expect, rates also to go down with inflation. One thing that isn't being maybe talked about, I'll throw it out there, and this might be for another call, is that, the AI comments, right? The debates on what's happening there. I don't know the timing of this, but typically technology in general is deflationary over time, right? Over economic cycles. And it's probable that AI, which is just another form of technology, right, is probably consistent with that. So I would expect that over time things cool off or find their way down.
And then a question about, you mentioned there's a lot of foreign investment and income coming in through the S&P 500 already. So do we even need to own anything outside of the US companies because we are getting that foreign exposure? Either one of you.
I mean, we could let Mark answer this one for sure, but I think the answer is always, because we go back to, again, we don't know what different asset classes will be doing or how they will be performing. So even if we have some of that captured from the US markets, we would still be missing out if we completely eliminated it. Between currency and other factors, we just don't want to completely eliminate something that we know is an important factor for long-term performance in a portfolio.
Yeah, and just to add real quickly to that, that 41% tied to the S&P, there's still 59% that's not tied, right? So there's a lot of opportunities still to diversify that risk and capture returns in the event US markets or US companies don't perform well. So I think there's a lot of reasons still to own.
Awesome. Well, in the interest of time, really quickly, thank you for those questions, everyone. We'll send out the recording, and we wanted to cover some CAM updates. We wanted to offer second opinion meetings. That's for any third-party investments you might have outside of CAM. If you have questions about the allocation and going into 2025, are you positioned correctly to mitigate the risks you have or concerns you have? We are now offering in 2025 the CAM short-term income strategy. That's for cash that you might have, or CDs or money markets that you're concerned as interest rates come down, as the Fed cuts rates, trying to get a little bit more for that cash. You might have emergency reserves, or you need it for a house, other kind of expenditures. We are also offering tax-aware strategies. That's still top of mind, taxes for clients. And then private investments for those of you that are interested and it makes sense. We are continuing to expand very selectively, as Mark mentioned, to the private investments where it makes sense. We're slow to add those, but we are always looking for new opportunities for clients. And the most exciting, Mark, you've been working really hard. Thank you for this last one. Can you tell us a little bit about Fidelity?
Yeah, no, it's been a process. We are in the process. It's taking some time because logistics and compliance and all that fun stuff. But we are adding Fidelity as an additional custodian. Following the TD and Schwab merger, we wanted more choices and options for clients, but also some things that would also not just help our clients currently, but really be able to expand the things we can do for existing and prospective new clients. And so Fidelity, we expect over the coming weeks, we'll get things in place to be able to offer. So clients at Schwab, if they're going to be better off at Fidelity, that will be an option. I don't anticipate, everyone will want to make a change just for the sake of a change. We'll actually expect that we're going to have a very even split in the long run across both platforms. Part of the reason and the benefit is it gives options, not just in terms of lowering costs for some clients if they're on Fidelity versus Schwab. There are some options for investments, some of the tax-aware strategies that Alyssa highlighted. For a lot of clients that have stock compensation or stock options, we work a lot with Fidelity's group already in some of these areas, so it'll just help us better serve you and give another option, even retirement plans you have at Fidelity. So we're excited about it. We think it's going to help provide more options, enhance services, and maybe lower costs for some clients where it makes sense, but we still expect a lot of clients, if not half or more, to remain on Schwab.
Awesome. Thank you for that, sharing that. If you're interested in moving over to Fidelity, please let us know. And then we can get started as soon as we get the green light from them to start moving your accounts over. And with that, that concludes our webcast. We will be sending out the recording. We will get you information next week about our February webcast and the topic. And again, if you have any topics of interest you want us to cover this year, please send that our way. Thank you and have a great rest of your week. Bye.
Bye.